Yeah, Melissa, really big changes in the outlook for growth this quarter, powered by strong consumer spending we saw in January, leftover fiscal stimulus from last year, and more stimulus expected. But the higher growth, as you're just talking about with Paulson there, comes with growing concerns about whether the economy will run too hot. The CNBC Rapid update showing the average forecast looking for 6% growth this quarter. That's almost double what was forecast last month. Better growth expected to continue for the next 2 quarters between 7 and 9%, before coming down to a still strong 4.3% by year end. For the full year, growth is forecast at 6.5% now. On inflation, Goldman Sachs said it was less worried than others because the relief is a one-time event and imports should offset pricing pressures. Under Goldman's scenario, the economy should be back to its potential by the end of this year. And a lot of this guy's going to come up tomorrow in Fed Chair Jay Powell's testimony, or annual testimony, semi-annual testimony in Congress. Melissa?
Steve, I'm curious, if you had the opportunity to ask him a question tomorrow, what would you ask him? Because I think a lot of market participants are obsessed with this fact that the bond market seems to be telegraphing the expectation that inflation will, in fact, be hotter. And so whether or not Jay Powell and company decide to do anything with where they stand on monetary stimulus, it could be the bond market that just decides what to do anyway.
I think that's a good area to question, Melissa, the idea of how much tolerance do you have for higher bond yields? At what point do higher bond yields start to impact the ability of the economy to grow or become constraining on the economy? I think another important question is whether or not any of this would lead the Fed to back off. Any of the growth numbers I was just talking about would lead the Fed to back off on that $120 billion of monthly purchases that it makes.
Shepard Smith here. Thanks for watching CNBC on YouTube.